All eyes at the World Economic Forum in Davos today were on the European Central Bank as it announced its decision regarding the long-awaited quantitative easing. We're joined in the studio by Laurence Schreiber, co-president of Clarity Capital, for an understanding of what that means for the struggling Eurozone and what challenges lie ahead. Mr. Schreiber, thanks for joining us.
Thanks for having me, Benjamin.
So what is the significance of billions of euros in bonds being bought per month and then injected into the trade bloc? What does it mean for the EU?
Absolutely. It's a great question. The European Central Bank has been attempting to stimulate the economy now for several years, but they've had limited tools that they could use. Central banks generally can only focus on the very, very short end of the interest rate curve by increasing or decreasing the short-term rate. The U.S. started several years ago the first program of quantitative easing in a large scale. What that essentially means is they are authorized to buy their own government bonds, which allows them to essentially influence the long-term interest rates.
Right.
And by buying bonds and artificially pushing down long-term interest rates, they're able to provide an additional level of stimulus.
So how long will it take to have an impact?
It's a great question, and I don't think any of us really know the answer. It'll be very interesting in the days and weeks ahead to see how the market responds. They're actually just announcing today that the scope of the program will be approximately 50 billion euros a month through the end of 2016. That's slightly above what I think most market participants had expected. So we are getting some slight positive impact, but it remains to be seen how this will play out over the next few weeks.
Of course. And what role does the appreciation of the Swiss franc play in all of this?
Well, that was a huge shock. Last week, the Swiss Central Bank, clearly now we see in preparation for what was going to happen this week in Europe, announced a real surprise, which was for 3 years they had pegged the Swiss franc to the euro, not allowing it to strengthen. And they shocked the markets last Thursday when they removed that peg. The Swiss franc appreciated 43% immediately during the course of the day and settled about 20% stronger. The ripple that had through markets ended up shutting down a number of hedge funds. Major banks took big losses. Clearly, markets were not prepared for that. On the other hand, the announcement by the European Central Bank seems to have been much more expected. And clearly, we're seeing that the markets are ready for this to happen. It would be a shock if they not made these big moves.
Now, would you say, these are obviously two big key subjects at Davos. Where do you see it going in terms of the quantitative easing in Europe?
Well, so I think that this is an absolutely necessary step. I think if the ECB had not stepped in, there is starting to be despair about what could be done for Europe to restart the engine. The problems in Russia, the problems with oil prices decreasing, which is hurting many of the oil exporting countries, that's just another step down for the economy. So they needed to take action. I think what we'll see now is there'll be a pause.
Right.
We'll let the stimulus take effect, and hopefully that will start to restart the engine. In terms of Davos, I think the most immediate impact for participants there is their hotel bills just got 20 or 30% more expensive when they check out in Swiss francs, based on what happened last week.
Will we actually see the money trickle down?
So that's a great question. When the United States did its quantitative easing, it was relatively simple because you had one central bank and one country. In Europe, you have one central bank, but 19 different countries, each with their own sovereign treasuries. So now the ECB has to decide which countries' bonds will they buy and in what amounts. And those are the announcements that are just coming out today. And as they continue to pursue this program, there will be a lot of questions about which countries will be stimulated and in what order. And there's going to be a real challenge for the ECB to manage that without seeming to be partial to individual nations.
Okay, now one of the main challenges for the European zone has been, of course, that you have Germany on the one hand, very strong economy, you have the pigs, so to speak, the southern European economies. On the other hand, big differences in terms of whether they are fighting, deflation versus inflation. How does the quantitative easing, how could it affect Germany versus, the pigs?
Correct. Great question again. We've already seen in the very short term, since the announcement, interest rates in Germany started to rise despite the fact that they've announced they're going to be buying bonds,
Right.
while interest rates in the peripheral countries have actually declined. So the market is expecting the bulk of the stimulus to be happening in these peripheral countries, which really need the support, and probably at the expense of Germany. So once again, if this continues to play out as expected, Germany will be the driver, will be the engine supporting the rest of the countries. And it will become a big political risk as well. How long will Germans be willing to say, we will support our less well-off neighbors?
And where does this leave Europe's second economy, France?
So France is actually in a stronger economic situation than many of the other peripheral countries, but they don't like taking a second seat to Germany. They want to be more involved and active in decision-making, and I think they will continue to make their voices heard.
Okay. Well, Laurence Schreiber, co-president of Clarity Capital, thanks for joining us.
My pleasure, Benjamin.
Thank you.